Brentwood Country Mart. And we're live. Hi, everyone. Allie Wyatt, co-founder and CEO of Female Founder Collective, the 10th House, which is our private membership community, and the North, which is our expert advisory marketplace. And I'm here today with Deb Benton, who is an exceptional human being as well as an exceptional career woman who has had the most illustrious career that I'm going to talk a little bit about first because she has lots of great advice to share with us today, and we're super excited to have her. So thank you for being here. I'm going to jump right in. Your bio is you are the founder and general partner at Willow Growth Partners. It provides early growth capital to entrepreneurs building the next generation of transformative consumer brands and disruptive technologies that power them. In 2014, Deborah launched a family office investment vehicle focused on seed stage consumer businesses and enabling tech companies. And prior to Willow, Deb invested in 15 companies and achieved 7 liquidity events, realizing 2.6 times the invested capital and significant unrealized gains, with a portfolio currently sitting at 10.6 times MOIC, which is multiple on invested capital. I just learned that term myself. So thank you for bearing with me. All remaining portfolio companies are active, healthy, growing, and providing significant unrealized gains. So huge congrats on that. I think in this market especially, it's a massive achievement. But I'm going to dive in because we have a lot of questions that our members asked ahead of time, but also that I have. And I'm going to dive into the before founding Willow, because when you were in your previous life, you were actually an operator, which I think is a really helpful insight to have as an investor. And you were the president and COO of Nasty Gal, where you led the team that grew annual revenues from 20 million to almost 100 million in 2 years. And a large part of that role was actually building the infrastructure to support this meteoric growth. Can you talk about hiring specifically and what hires supported that growth?
So I met Sophia Amoroso, who was the founder of Nasty Gal in 2011, I believe. I was really intrigued with what she was building. She had done a phenomenal job of creating this online destination that it's interesting. It wasn't even really, I would call a brand at the time because she hadn't vertically integrated. She didn't have her own brand. She was curating a collection from a variety of suppliers and putting it online in a really unique way, in a really elevated way. And so it was more of a destination with a highly curated assortment. And she did an absolutely brilliant job of
I didn't even know that, by the way. That's so interesting.
Yeah.
It wasn't private label initially.
No, not at all. In fact, in the earliest days, she was buying vintage and had an eBay store and was reselling kind of this vintage. And learned pretty quickly on that you can't replicate that because it's lot size of one with vintage items, and so there was all this kind of cost and overhead that was going in only to sell one single piece. So she quickly, was like, wait a minute, if I buy 10 pieces and I can kind of amortize those costs over 10 pieces, and that's a stronger business model. So she started, she was still up in San Francisco at the time, and started driving down in her car and packing her trunk full of product that she would buy down in Los Angeles, drive it back and sell it. And she just did an incredible job of, at the time, this was 2009, 2010, this was really early on, of creating kind of a branded experience, not at that time an actual clothing brand. So we met, and I was really intrigued. She had just moved the business down to Los Angeles. The business was exploding. You could feel the excitement around this business. There was a lot of buzz. I was the COO at Shoe Dazzle at the time, and all of the kind of women, the buyers that were squarely in Nasty Gal's target were like buzzing about this brand. And I'm like, oh, wait a minute. I think the founder just reached out to me. So we struck up a friendship. I had a lot of admiration for what she had built. It was a really exciting time. She hadn't raised any capital at this time, and the company was about to do around $20 million. I mean, it was extraordinary what she built. I mean, absolutely extraordinary.
Just from the vintage and curated pieces.
Yes, yes. And with no outside capital at all at this point. So when I joined her, she was in the process of raising her first outside capital from Index Ventures. And it was a lot of capital. And one of the things I say, because I've moved on to the investing side, and Sophia, I'm sure would agree with me here if she were on the call. For these brands, and I made all the mistakes as the operator, by the way, that has informed very much how I invest in creating a thesis going forward. I encourage brands to raise as little capital as possible, get profitability as quickly. Consumer brands. Yeah, very different. Back then, consumer brands were being invested in by the same people that were investing in enterprise SaaS and health tech. And I mean, it was crazy. This is a whole different.
And this is sort of a different topic, but there are a number of questions that our members have asked. But can you talk about, not to divert us too much, but talk about the difference, right? Why that is different when you have the importance of that and a tech investor investing also in a consumer company?
Yeah, for sure. I mean, if you just start, like, don't even look structurally at how these two categories operate. We'll come to that, but look at how these companies traditionally exit. Start there, because as an investor, you're always underwriting, right? You're underwriting the return. You're going through this diligence process, and you're thinking about returns. So in the consumer brands world, we're not investing in companies that are putting people on Mars, right? Like, we're not investing in kind of the really, really cutting edge frontier of new tech or what have you. We kind of know the path. There's a lot of innovation going on, material science, distribution, maybe integrating some technical components to help the consumer's experience improve or what have you. But we kind of know the path of these brands. The vast majority of these brands are going to exit through M&A, whether they sell directly into a strategic, or if they sell the majority or full into a later stage financial sponsor, who then will sell it to a strategic. We kind of know the path. The number of these companies that are going to go public is minuscule. Most of these companies should never be public. When you think about what's the rhyme or reason for this company being public, but they make phenomenal acquisitions for the larger consumer brands. Like, think of a L'Oreal or a Willow. Think of Estee Lauder. This is all on the beauty side. On the apparel side, you've got really big conglomerates that would love to acquire these smaller brands that are really exciting and rapidly growing. So if you just start there on how to underwrite, and you look at the distribution of M&A that's happening, the vast majority of these brands are exiting kind of between, let's say, 200 and 700. Like, that's kind of where the most. So already, if you understand kind of the portfolio construction of tech VC, the way that they make money is 1 out of 15 will return the fund multiple times, and they have a very high loss ratio, because they are taking on a lot of risk of a lot of cutting edge stuff that's never going to take off. That's okay, but they need to have that one multi-billion-dollar exit to pay their fund back.
Right.
Our construction is very, very different. We are much more moderate in the kind of exits we expect to get, and we help these businesses grow in a really healthy way. And if they get to a 250 or 300 or 350 exit, that's a phenomenal exit. Don't raise too much cash. Be diligent about getting to profitability, unit economics, margin, and don't take too much dilution. We're very protective of the founder's ownership. So even if you just start with kind of the exit path of these two categories and how different they are, of course, how can you have the same investors with their investment thesis for a tech company investing successfully into a brand? The answer is you can't. You have to have a very, very different perspective. And so I made all of these mistakes. I own this. At the time there was only tech VCs really that was providing early stage
I was
capital.
going to say it wasn't necessarily a mistake. It was just how the world operated at that point in time.
Yeah, yeah. No, I'm happy to talk about mistakes because I probably learned the vast majority in my career from my mistakes. It's funny, as a society, we are always like, we're afraid of failing. We're afraid of failing. Oh my goodness. I mean, look how much we learn through failure, right? That's how we get progression. So embracing, of course we don't set out to make mistakes. Don't get me wrong. Like you don't want to, but there's a whole bunch of learning through this constant feedback loop of, they say fail quickly, learn, pivot, move. So I was seeing this for a number of years. And at that point was like, okay, this is crazy. Why are we thinking about this category of companies in the same way? Left operating in 2014. And that's when I began kind of the individual investing. And, my checks were small. They were kind of 50,000 to 200,000. I wasn't leading rounds, but I really wanted to help these founders think about how they scaled their business and be more thoughtful about the partners that they brought around who were going to push them in a certain way to scale. So I did that for those 6 years and really honed my thesis. The market was changing quite a bit. It was becoming, when I first started doing this, everybody was like, you're crazy. Like, that's not how to think about it. And I'm like, well, I kind of think it is. And as it turns out, it is. I wasn't right about everything, but, again, in the theme of constant learning. And that was really what predicated the launch of Willow.
And at Willow, how did your strategy change? What is your thesis there? And when you say seed stage businesses, how do you qualify that? And what sorts of check sizes do you write? Do you lead rounds? Can you share a little bit more about your thesis
definitely.
here?
So what we do at Willow is identical to what I was doing as an angel. We are very disciplined on valuations. So we're generally getting into businesses sub 10 million pre-money valuations. And we're not disciplined on valuations because we're greedy or cheap. We're doing it because we understand the cadence and we understand the journey. And at the end, if we do it the right way, everybody will be successful. This should not be investors are successful at the expense of the founder. We're very, very protective of the founders' ownership. We don't want them to take too much dilution. We don't want them to raise too much capital. We would much rather this business start to throw off a little bit of cash and raise the necessary capital, not to impede growth, but to ensure that you have very healthy growth. So we're the first institutional investor. The rounds are generally about 3 million. Our preference is to lead. When we're leading right now, we're just in the process of raising our next fund. So we're finishing up deploying out of this current fund. And when we were leading out of this current fund, we were writing about $1 million to $1.5 million of the $3 million round. We were looking to get, at least 10% ownership. For our next fund, which will be a larger fund, 75 to 100 is what we're targeting. Same construction, exactly, portfolio construction, but we want to write a bigger check. So that first financing is about 3 million. We'd like to write 2 to 2.5 to be able to get 15 to 20% ownership. We're very different than most early stage investors. We have a more concentrated portfolio and we work very hard with our founders. We ask them to think of us as an extension of the team wherever they need help, especially that first kind of 12 to 18 months after we write the check. There's a lot of, often these companies have 3 people, they're tiny. So it's helping build the infrastructure, get all the right systems in place, get the right partnership in place, get the right supply chain, co-mans, distribution, margin profile, just setting everything up. And then generally the cadence is 12 to 18 months later, they'll be ready for what we colloquially call the Series A or early growth round. And that round might be an $8 to $15 million round. And for many of our companies, they'll never raise again. We would love that. If they have the margin profile to support not raising again, we're very happy that that's the last round that they'll do.
Deb, can you speak a little too? Because a lot of founders find that investors want them to continue raising. Can you talk about why that is and why you're different in that respect? Or like why you don't encourage founders to do that?
Yes, it comes back to the fundamental differences between how tech companies scale and and what's rewarded in the market for these tech companies and consumer brands. So in the tech world, generally top line growth. If you think about kind of the new subcategories that get created, like think of Uber and Lyft, right? There were fundamentally two winners that came out of it. There were a lot of other rideshare programs, by the way, that and businesses that got funded, but never really quite took off. What I've observed is in the tech world, one or two, maybe three, but really one or two tend to dominate and kind of win at the expense of everybody else. So there's a whole bunch of capital that goes into this, kind of newly emerging sector, and one or two will win and win really, really big. And those tech VCs are hoping that they're part of one of two of those. In the consumer brands world, many brands will win. Many, because the consumer generally, what I've observed is consumers are wanting to spend their money with brands where they feel closely aligned from a values perspective. They feel that they're part of this embedded community. They feel validated by being part of it. They're actually looking to identify with the brands, especially more intimate brands like beauty and personal care. Consumers are much more concerned about what does the brand stand for? What is the ingredient profile of its food and beverage? What's the nutritional profile? Are there kind of underlying values that makes me want to support this brand? The consumer's a lot pickier these days, which I love. I think consumers using their hard-earned money, they should get exactly what they want, which is, many different brands out there. What it also means is that there's not going to be one or two massive winners. What it means is there's going to be a number of winners that, maybe the brand gets to $100 million. Like, that's a phenomenal win, but it's not a phenomenal win if you've raised $73 million at a 500 pre-money valuation. Like that's going to be a loss all around. Yeah. So when you have on the tech side, they keep wanting companies to raise, mostly because they're always operating at a loss. And I'm not saying that that's wrong for that sector. What they want is top line growth, because they want market share. Big market share will be a driver of success, that it will be one of the one or two big winners. That's not the case in the consumer brands world at all. A healthy, sustainable business that is, EBITDA positive, that continues to grow, that's attracting a new demographic, that's, responding to new values, new materials, new innovation. That is what the strategics want to buy. It'll be at depending on the category and the margin profile, it could be as low as a 2x top line multiple. It could be as high as a 25, sometimes in the spirits in the beverage world. But I encourage founders not to build a business to sell, but to be cognizant of the structure within the market and build relationships with these strategics or financial sponsors early on, just so that you're informed as to kind of what's going on. But that's fundamentally the difference. The difference is on the tech side, raise. They also want the markups. That's a whole other conversation. We are not a markup game whatsoever. Again, our companies raise far less and far less frequently. So we're definitely not a markup game. Like, we are looking for exits. We're looking for DPI, which is actual distributions. So there's some, and I'm not saying everything on the tech side is nefarious at all whatsoever. There's amazing things happening over there. There's some really good reason to keep raising, especially if it's engineering heavy, labor heavy, infrastructure heavy, asset heavy. There's a lot of good reasons, but it's this structural, the structure of the tech side is just very different than the consumer brands, and the exits are very, very different. And so it's warranted when it's done in a healthy way to keep raising over here, because you do have to keep spending for growth, because growth is very much rewarded. Whereas on the consumer side,
and changing your valuation. Right.
Yes. And getting your markups, getting your higher.
And getting the markups for the
generally based on your top line growth and not on your margin profile. On the consumer's brand side, we're a lot more focused on a healthy, sustainable business, which generally means like we can see getting to an operating profit.
Yeah. There are a lot of consumer businesses that are concerned right now, right? Because it's a very difficult market to raise capital in, but you're obviously focused on consumers. Lanning A, one of our members, said she's a founder who's seeking seed funding, and she asked, what is the ideal stage of development or level of traction that would make a startup particularly attractive to you? And are there specific milestones or metrics that you look for when evaluating or that determine ultimately? You said the $10 million mark really as the highest valuation ceiling. But are there any other sort of minimum levels of distribution or revenues that you have as a benchmark?
Yeah, it's a great question. I would say there's some variance by categories. So what we look for example, in food and beverage, which is a very different category in terms of margin profile and distribution channels, and even exits, the way that we look and assess those deals will be different than, for example, a beauty deal. So there are some differences, but let me focus on the similarities. Our theme is mostly around wellness. I would say broadly wellness. We focus on the categories of beauty, personal care, food and beverage, baby, pet, and CPG, health and wellness. So we don't get into pharma. We don't get into. We have one company that's working on a patent, but for the most part, we are consumer brands. We're not, super R&D heavy, pharmaceuticals, FDA, FTC. Well, we have to deal with FTC a little bit, but so in general, we're looking for trailing 12 revenue of around 2 million. So it's very early, but they are in market and they have reasonable traction. We're looking for very strong product margins. One of the reasons, as an angel investor, I did a fair bit of investing in apparel. Out of Willow, we really stay away from apparel, to be honest.
Yeah.
It's a fantastic category. I've worked a lot in apparel. It's very, very difficult. It's just a very difficult category all around. But I would say, product margin, fully loaded gross margin, contribution 1, contribution 2, those margins we'll all look at, knowing the business is highly subscale. And so we can certainly model out improvements as the company scales of where we think we'll get some benefit. We're a little less concerned about EBITDA at this point because generally all the companies are EBITDA negative. What we will look at, though, is kind of allocation of resources and how the founder is spending. We are looking for discipline right from the very beginning. So if you've got a business that's doing $2 million in revenue, but you're spending $3 million on marketing and another $2 million on headcount, I'd be like, okay, well, let's talk that through. Maybe there's a good reason. And we can always have a conversation about it. But I definitely want to see founders with a mindset of lean and mean, ROI focused. Every dollar, how are we spending? What's the kind of return that we're getting on it? Because I think if you instill that discipline early on, you will build a sustainable and healthy business. And we're not looking for silly, stupid, unhealthy top line growth. We're looking for aggressive growth, but it's done in a very healthy way that's driving towards a profitable business. So, we'll look at, we're very interested in brands that are creating repeatable purchasing. We're looking for platforms that are building a relationship with a consumer. There's a lot of businesses out there where transactionally you're kind of one and dones. That's fine. That's not what we're looking for. We really are looking for brands that consumers are looking to for their everyday lives. We really like replenishment. We like consumables. And again, that relationship between the consumer and the brand is imperative for us. So it's generally, we're really keenly interested in brands that are values led. They're putting great products, highly differentiated, better functionally products into the world. But more than that, they have a perspective of their impact on the world. So it could be through sustainability, it could be better nutrition, it could be democratized access through mass or value pricing, so that more people can have access to a better for you. We're looking at, we love companies that are thinking about the elimination of single-use plastic. We have a company that's thinking about water conservation. All of these elements, not only are they personally important to me, and I feel good about investing behind brands and founders that are working towards solving some of these problems, even in their own small way. I also think that matters to the consumer today.
Yeah. I was actually just going to ask about that. If you feel like it's almost a table stakes must have for consumer businesses today,
I know you would
have
think
some
that.
sort of purpose.
Yeah, you would think that, but we see a ton where that's not the case. And again, I am not like Judge Judy. I'm not. I don't ever want to tell anybody what to do. Like, I think that there's a place for that. It's all about finding the right partner, right? The
Yeah.
right partner. I like being very passionate about the brands and the founders that we invest in because we work very closely. I get a lot of excitement. I get a lot of reward about helping these folks scale their business and be successful. I want to believe in the brand and the founder myself. It's a little bit selfish, but I want to share in that joy and be aligned because I know I'll work harder. To be perfectly frank, I'll just work harder. But yeah, you would think that in today everybody would be thinking about this, but we have don't forget, we have a pretty West Coast progressive perspective. These things, tend to culturally be really important to us. Not everybody feels that way, and that's totally fine. That's, we have the advantage because, we own Willow. We can invest in what we want.
Right. But I do think that you're seeing sort of consumers more and more need it, especially with Gen Z, to
Definitely.
be sort of part of the value proposition. I want to talk a little bit about expectations with the lens of the market that we're in right now. Like, I don't know, have you seen any change, or have you imparted sort of any change in how you're going through and diligencing companies that you are looking at to invest in? Or is there anything in this particular market that has become more attractive to you in companies that you might potentially invest in?
Yeah, we actually get asked this quite a bit. I would say so. There's the broader market, and then there's Willow. We have always, because we've always kind of been very disciplined and conservative on this side of wanting to build real businesses. That there's been no adjustment for us personally, but I can tell you in the broader market, the focus on cash conservation and being very conscientious and very disciplined about how you spend each dollar. Eye on profitability, again, especially in our sector, that is kind of like the new norm. I'm like, why was that not always the norm? It should always have been the norm, but it's certainly a much more conservative approach. I think that's super healthy. I think that's how we will, these markets are cyclical. So who knows, in a couple of years, we'll be back to the craziness. Maybe, I mean, Willow won't, but maybe the broader market will. I'd say that the number of deals, just the deal count, is significantly down year over year. So while there's a lot of dry powder, there's a lot of capital out there to invest. A lot of investors are sitting on the sideline and kind of waiting it out, or they're reallocating to their reserves. Reserves is capital that they reserve for their existing portfolio to try to help them through some difficult times. So they may move capital that was allocated for origination to do new deals over to the reserves to support their existing portfolio. So I think founder expectations, again, we're pretty transparent about how we think of things. So nobody's really surprised when we have this conversation, and we do have these conversations all the time. We certainly saw this year in particular, a lot of companies coming back around that had raised at too high evaluations in the last couple of years. And they were coming back around, and they were, either opening up the last round or doing a flat round, or God forbid, having to do a down round. And it's not the end of the world. It's not the end of the world, but it adds a higher friction to an already difficult journey, to be perfectly honest, which is why when we talk to founders, we really like to talk to them about their ownership and preserving their ownership and what the journey will look like, rather than some artificial made up valuation number, which really is just completely speculative and for the most part completely made up. We'd rather spend the time and sit down and say, this is how we're thinking about it. This is what we think you'll have to do. And we'll model everything out. We think you'll have to do one more round. This is where your ownership should be, should everything go out as planned. And hopefully you'll never have to raise again. And this is how we're thinking about potential exits. We'll go through that. We're not always right, don't get me wrong. And there's a lot of exogenous factors that we certainly can't control. But I would much rather that be in a conversation up front.
And is there anything that you recommend, like that you're recommending to your portfolio companies, for example, to put off having to raise another round? Because I know a lot of businesses are struggling with working capital, or there's a lot of consumer businesses that are like, great, so investors are telling me not to raise money, but then how do I
How do I
cover the
grow?
cost of
How do
my
I
initial
operate?
inventory and like grow
Yeah,
this business, right?
yeah. Yeah, it's hard. I mean, I know it's hard, especially if you have founders. Again, this goes back to getting the right partners. If founders have partners that don't understand, there are unique nuances about consumer brands, namely inventory. Managing inventory and managing the cash conversion cycles is very unique to consumer brands that any investor that hasn't worked in a consumer brand, has only worked in a tech company, has no idea, right? They have no idea how hard that can be. You can be an incredibly successful, very fast growing brand, like rapid, out of control growing, and run out of cash.
Right.
I mean, I've seen this happen before. Everything, it could not be going better. And you still run out of cash because of just the cash conversion cycles. So it is very tough. I feel for founders that are getting this messaging like, yes, you need to continue to grow, but no, you can't raise any capital, especially if they have not built the business from day one in a very disciplined way and really understanding nuances of cash. And I'd say if you don't have somebody that really understands financials, managing cash, I would encourage everybody to get, it could be a part-time person, it could be a contracted person. There's some great outsource companies that can support you here, but it is a critical element of these businesses is managing your liquidity. There's definitely debt options depending on the size. The smaller you are, much more difficult. But once you raise, we're known in the industry now, so a lot of debt providers will come in beside us and provide debt. We love healthy debt. It's great because it's
Yeah.
not non-dilutive. It's a little more expensive these days than it was in the past, but it's still less expensive than equity for sure. And owners don't have to take any dilution. So there are some options, but if there are no options, just manage your growth accordingly. Just manage it. You may not,
Just
you may,
slower,
just
grow
slower.
slower, and yeah.
You may not grow 100% this year. Okay. That's okay. This is going to be a tough year and there's not going to be a lot of available cash to raise. So bring it down. Just making sure that your unit economics are good, making sure that, after all of your variable costs, your fully loaded gross margin for your category, you're sitting well. Then it's a matter of managing your fixed costs. And I know I make it sound easy, and it's not. None of this is easy. None of this is easy. But you don't need to. Don't force yourself to grow in a way that you can't afford, because then it becomes a moot point, right? You can't keep going.
I want to talk a little bit about the founders themselves, because we had founders who asked questions about, what do you look for in the actual founders, right? What do you look for in their teams? Can you speak a little bit to this as you're evaluating not only the business, but based off of your experience as an operator, I'm sure you probably have a POV on it.
Yeah, it's probably more important than the numbers, to be perfectly honest. Like it's everything. It is everything. These are relationships. These are people that it's not just getting into business with. This is, for the founder, this is often their everything. It's deeply, deeply, deeply personal. We are as a fund managing millions of dollars of other people's capital. Trust me, that's deeply personal for me as well. Like, that is a responsibility. Stewarding other people's capital is an extraordinary responsibility that we take really seriously. So finding people, founders and teams, but particularly founders that we feel we are aligned with from a values perspective, is very important. We will, unlike other really early stage investors where often deals are kind of done in a few days, we take months, sometimes years. The deal that we're finishing right now, we have known them for 3.5 years. That's on the long side for sure. We knew them before they ever launched. But I would say, oh man, that relationship, it's also life's too short, right? Like, who needs the aggravation? Just finding people that transparent communication, collaborative. We're all in this together. We're here to help. Please don't be territorial. Like, we literally are all aligned in kind of the outcome that we want. That is very important to us. And we will spend quite a bit of time in person, on Zoom, problem solving. What does success mean to you? Like, how do you define that? What does it mean for your family? Like, just making sure that we're talking about important things that we'll have to address as we go through the business and scale the business anyway.
And how do you evaluate like the founder's ability to that in the process of pitching, right? And I know you said it takes longer, but are there any things that sort of stick out to you in the actual pitch itself that
It,
are sort of signals of whether or not this person is a good fit for Willow specifically?
yeah, it's obviously a staged process. If it's the very first pitch, I personally, I'm really interested in why they launched this business. So the origin story for me is really important. It's a good proxy for how meaningful is this? How authentic is this? Do they really understand the problem that they're solving? Do they really think that they have this truly unique differentiation that can solve the problem? Can they define that? Do they have an unfair advantage in solving this problem? This is going to be a hard road. It's going to be a long and hard road. Tenacity, persistence, managing stress, all of that really comes down to, like, why are you even doing this? Because nobody in their right mind would actually ever do this. Like, truly, like, this is an insane endeavor. Like, you better really, really, really be passionate. This is not something you do because, no, I didn't like my last job, or I don't want a 9 to 5. Like, this is going to be the hardest thing that you ever do in your life. One of the hardest things that you ever do in your life. So sussing that out, for me, is a really good starting point. And that's generally, even if it's a 30-minute call. And don't forget, as you guys are doing your pitches and talking to investors, always think about what the goal is of that particular call. On that first call, the only goal is to get a second call. That's the only goal. Nobody's writing a check. Well, I can tell you, we certainly are not. After that first call, the only goal it should be is to create a rapport, to create a early relationship, to see if there's a fit on both sides. By the way, it's not just one way. It's not just us assessing the brand. The brand should also be assessing us. Like,
How do they do that? Because I think a lot of founders are very hesitant to say anything and feel like, oh, if I can get money, fantastic.
Yeah, I know, because it is a really hard endeavor. And by the way, I always tell founders this, like, I've raised capital as an operator, so I know how crappy that is. Don't forget, as a fund, we also raise capital. We're in the middle of a capital raise right now. So we are very empathetic towards how difficult this can be. And, it's not your core business. It's not, you really want to just be running the business. I totally get it. I would say, yeah, no, founders have to be judicious. They really do. Do not take capital just for the sake of taking capital. It's like marrying somebody just for the sake of getting married. It's going to be a disaster. Like, it really, really is. You have to figure out, are you aligned? You want your financial partners. They're going to be at the table with you. Not all of them. Some of them may be passive, and that's great. But at least your lead, and maybe there's a co-lead, or maybe there's like a big participating fund. You want them to be passionate about your business. You want to have the hard conversations. You really do. Like, I would really encourage you. I got on a call with a young woman from Australia a few days ago, and she was phenomenal. Like, she was asking me tons of questions. She wants to talk to some of my founders to figure out, how do we work? Like, I respect that. I do.
Yeah.
I do, because
that's probably as much about that founder as them pitching you, right?
yes,
Is the kind of questions they're asking.
absolutely. And the desire for them to want to find the right partner, and not just, find any partner at all costs. I really liked that. It made me remember her. Now, there's a line. Don't get me wrong. Don't get me wrong. Like, I wouldn't enter into your first call with, like 30 questions peppering the investor. I think that would probably also be annoying. Like, you need to manage it. You need to manage the relationship, but it is a two-way street.
Yeah. Yeah, I love that you say that because I think it's so important for founders to remember, and it's frankly it's hard to remember. Any mistakes that stand out to you? Siobhan Frost had asked. There's
Oh my
specific
God.
things that have stood out as like red flag,
Oh.
or that sort of shut it down pretty quickly, or were the things that you said, okay, no second call?
Well, I would divide it into, there is out of scope. So, we have a very specific, and this is something important that people have to understand. Funds generally have pretty specific criteria and stages,
Yeah.
ownership requirements. Like there's some criteria, whether it's, are you in the right category? Do we have a conflicting portfolio company? We'll never invest in something that competes directly with an existing portfolio company. That's unfair to
But some
everybody.
funds do, right? Some funds are
Some
like,
funds
it's like
do.
they have a general thesis on a category, and so they will do multiple.
Yeah, some of them do, particularly if they are participating and not the lead investor. I think it's hard to be a lead investor in two direct competitors. I don't
Yeah.
know. Like, you would have to be very careful to draw lines because there's obviously confidential information.
Yeah.
Many funds don't lead and they just throw kind of a participating check in. I think that's a different story. If they're not, if they don't have information rights, or if they're not seated at the board table, or they don't have access to really insider kind of proprietary information, that may be okay. But because we tend to get really involved and we want to be as helpful as we can, it would be hard for me to, like, a direct competitor. Obviously, we have multiple, like we'll do multiple in the hair care space, for example, but they won't be direct competitors kind of thing. So yeah, just going back to your question, like there's an immediate, we hope to try to filter out before we even waste anybody's time. If you are out of scope from a category, from a stage, from a size, from how much you're raising, we'll try to filter those out. And that's just a natural, it's just not a fit for us. I would say on the call itself, qualitatively, I like working with people. I want to see signs of collaboration. I want to see signs of partnership. We really do view this as a partnership. We view this as we're all sitting at the table. We don't want to run the business. Trust me, I ran businesses for a very long time. I got out of it for a very good reason. But we definitely want to know what's happening so we can be helpful if we can, right? If we don't know what's happening, we can't be helpful. And so being like a lack of transparency is really, really challenging for me to deal with. Any indication of deception or just not being absolutely truthful, it's just very frustrating for me. So I'd
Yeah.
say on the qualitative side, really figuring out, like, and by the way, I'm not saying that that's right for everybody, like, and that's not right for every fund. Again, this is just a very personal thing that's important to me, that if I can be helpful and be successful and hopefully help the founder be successful, these are things that are important to me.
Love that. Can you speak to how investors define transformative or disruptive? We had somebody ask that question, and they're like, what does that actually mean? And is there a way to quantify that or really highlight that? Or is it just
Don't you think that's
part of
just
the
like
pitch?
a nonsensical term that people throw away as a marketing term? I don't know. Like, no, we try to stay away from those. I guess you could, I mean, there certainly are, massively transformative businesses that come out. I would say, like, they're usually category defining. Like the
Yeah.
rideshare was probably, is probably pretty transformative. I think Airbnb, anything that structurally changes an existing category or creates a
But
new
it tends to
category,
be tech oriented.
I think it tends to be tech oriented. I think on the consumer side, again, I think it's through really interesting and progressive innovation. Like, you could say, I'm looking at a company now in the water filtration space, like that, which is a little out of scope, but it's actually fascinating. They've come up with some new hardware that is quite transformative, but I don't know. I think those terms. I think there's a lot of marketing lingo that goes on.
I
Uh,
would
on
agree with that.
Yeah, like on the brand side, I definitely like the progressive nature of some materials and new formulations and new ingredients. But there's innovation in pricing, right? I
Yeah.
mean, we're investors in a company called Bubble, which is a beautiful, wonderful clean skincare company, really focused on kind of the younger generation. The innovation there is the fact that how high quality these products are, and everything's under $20. I love that. Like that.
And
That
like
is
Nasty Gal was a transformative business,
absolutely,
right? In the
absolutely.
way that they did things. It's also how you operate, how you build your teams, how you market, how you
Yes.
distribute.
Yes,
Yeah.
absolutely. Yeah, no, Nasty Gal absolutely was like bringing that curated aesthetic online in a really elevated way. The consumer experience that was absolutely new, and there were a lot of fast followers. But Sophia kind of paved the way there, I think. So I think in the brand world, and obviously I'm much more biased towards the brand world, it's less about these massive sea changes and more about constant innovation and progression. Because don't forget, we also need to sell into consumers, and asking consumers to really radically change their behavior one day to the next. That's a heavy lift. If you can, and that's why for things like, we're investors in a company called Goodles, which is a much healthier, better for you mac
Love
and cheese.
Doodles.
Oh, it's so good. Like it's
We
so
had
delicious.
Jen on.
Oh, did you? Oh,
Yeah.
yeah, she's incredible. I mean, yeah. So that's not a heavy lift because people love mac and cheese. So we're not asking
Yeah.
consumers to change their behavior, but it's such a radically better product for something that they're already doing. So I think structurally, I think consumer brands are different. In the tech world, you can have sea change differences where consumers will, like, think about Facebook, right? I mean, whoa,
Yeah.
created social media in many ways. There were other things before it, but that really made it mainstream. I don't think we tend to have that on brands.
What about industries right now? In consumer, what are you seeing as trends and what sorts of within, because there's a lot of obviously different industries within consumer, what are the industries that you're really excited about? What are some of the innovations that you're looking for maybe in the consumer space or problems that you're looking for solutions for?
Yeah, again, I'd say we really like overall wellness. We really want to bring brands to consumers that are improving quality of life for consumers. That can come in many, many different ways. I'd say beauty personal care is always a really big focus of ours. We really love it. There's a strong trend right now on clinical and derm. Uh,
Mhm.
and new ingredients that are coming out that are really efficacious. That's interesting. Where there's been this explosion of med spa and a lot of it investment into med spa. So it's bringing more mainstream to people at probably a more approachable price. Um, Products that perhaps were only available before at a dermatologist or a really high-end med spa, something like that.
Yeah.
So I like that. Yeah, right now in the beauty space, I still really like hair. I think we're at the beginnings of kind of a hair revolution. We have an incredible investment in a beautiful clean hair care brand called Day. Anybody that shops at Sephora has seen Day out there. Love it. It's kind of that mainstream, easy to go to, beautiful, desert inspired, clean hair care brand that we invested in a few years ago, and they're killing it. They're great. But I think there's a lot more to do on scalp care,
Yeah.
hair care in general. We're doubling down there. I think on baby and juvenile, that's an age group that we also really like. There's things like gut health, brain
I was
health.
going to ask about health, women's health specifically.
Yes,
Do you
love
play
it.
at all in that category?
Yeah, love it. We are investors with Unilever in a company called Parallel, two amazing
Mhm.
women here in Los Angeles in the women's hormonal health. I'd say that whole category. They're focused on the reproductive years. We've spent a lot of time in perimenopause and menopause, like supporting women at different stages of their life.
Yeah.
We haven't found something that we really wanted to get behind yet, but my guess is in our
In
next.
menopause.
Yeah. Oh, perimenopause. It's really about supporting women from start to finish throughout their life.
Yeah.
So parallel really, they started off with the prenatal, and then they moved forward into conception and fertility, and now they've got solutions for specific reproductive issues that are far more prevalent, that nobody talks about, that 50% of the world deals with. So we love that, really love that. They're in the supplement space, but I think that there's a lot of other ways to support women as she progresses through life. I love that. That to me is we'll spend quite a bit of time there. And it's not just, hormones are very powerful. So helping women kind of manage hormonal health, but there are ancillary things that come from issues with hormones. So helping women deal with things like brain fog or memory loss or
I have brain fog with daylight savings.
oh my gosh.
You would think I would have more sleep, but
no, it's terrible. I was driving my son home from school yesterday. I'm in Malibu, and he's just over the canyon, and it was 3:30, and it felt like 7:30. I'm like, this is so depressing to me. I mean, just this time of year is challenging. Very beautiful, but a little bit challenging. So yeah, women's health for sure is a really big focus, and baby and juvenile. I think that there's a lot there. Pet, we really like. I think there's a lot more around kind of the humanization of pet. We spend a lot on our pets. A lot of people are choosing not to have children. Fine, but they want to have pets, and so giving them really good solutions for the pets. We have one investment right now, Maeve, which is a fantastic dog food company, frozen raw. Love it. Very healthy, making it accessible for any of you that tried to do the raw food diet, going to your local butcher and having to deal with that. Like, no, thank you. But Maeve, I know. But Maeve is great. You pour it like kibble. It's stored in your freezer and you pour it like kibble.
Love that.
So they're probably the big areas that we are, we pretty much stick to the 5 subcategories that we know well.
That's super helpful, I think, for everybody watching. I think it's so important for founders to understand a fund's focus, because there's a lot of time spent and wasted, frankly, on barking up the wrong tree.
So much.
So I always try to tell founders, like, make sure you understand what they're investing in and how they think about it, the check sizes, the strategy. And also, I loved how you talked about your strategy as a fund, right?
Yes.
Because at the end of the day, like you said, you're also responsible for people's money. And so that's your primary responsibility, is returning the fund to your LPs, right?
Yes.
Last question, because we're a little bit over time, but this has been so helpful and just so valuable.
Amazing.
Just I feel like we all got a 101 in also fund construction and strategy. But the question I have for you is, it's a crazy year going into 2024. None of us, of course, have a crystal ball, but how are you thinking about investing and looking for businesses? Has sort of your thought process changed? I know you said you're going to be doing bigger checks, but is there anything that you can give by way of advice to founders who are going into their fundraising season and trying to understand how investors are thinking?
Yeah, it's a great question. I think, this is a personal take, what I think is going on. I think 24, I think the consumer is going to feel pinched in 24. Leading up to this point, when you look at even going way back to the stimulus and consumers spending, consumer growth, like it's really conflicting. Consumer spending has continued to grow despite the craziness of the last 4 years, which is really encouraging, because I think the consumer is still, I think there's been an evolution around how the consumer perceives life and what's important, and a reprioritization, which I think is really quite healthy. That, maybe I don't just like save for a rainy day. Maybe enjoying the day to day is also really important. That doesn't mean going out and splurging and spending in a risky way, but the small moments of joy that I can give myself. And maybe it's a new lipstick, or maybe it's really focusing on my health, and my health has become incredibly important. And so buying that supplement every month makes me feel better, and it's an investment in my future. I think that is going to continue. A couple of things that worry me: credit card debt just exceeded $1 trillion mark in the US for the first time ever. So I'm worried about that. The student debt just started accruing interest again back in September. So I'm worried about the younger folks that are, still trying to pay their student debts back. We're going into a crazy election year, a lot of volatility, a lot of separation. And of course, the geopolitical situation is really, really, really worrying. So that's weighing heavily on the consumer's mind, I think. And I think that will have some impact on spending and where people are spending. But if you look at the spending trends, it's still growing a little bit, which is really positive. I think consumers are being very thoughtful about where they're spending their money. They want those little experiences. Restaurants and travel, as you mentioned earlier, are still up, which is interesting, despite, oh my gosh, they're so expensive these days. And our categories: beauty, personal care, health and wellness, pet, baby, they are doing really well, because I think it's less about the actual.
They're non-negotiables.
They're non-negotiables, and I think as long as you have
or affordable luxuries.
Yeah, it's the value proposition. For me, what I see with consumers, it's less about the actual dollar sign, because we don't invest in luxury and we don't invest in big ticket items. That's not us. We are, those categories, we're really looking for the replenishable, everyday things that consumers use and love, that bring joy to their life. They're pretty much non-negotiables. And I would say to founders, really focus on your value proposition. It's less about the dollar. You'll have to do some pricing studies, and you'll have to look at things like yield curves, and if you're on shelf, like your competitors, and understanding the competitive environment where you're playing. But really, if you look at a company like Coterie, it's a little bit counterintuitive. It's a baby personal care, premium, ultra premium, some people would say diapers. But man, that value proposition is incredible. And we've seen that company continues to astonish me.
And their service is phenomenal too. So
service is phenomenal. So if you just make sure that whatever brand you're building, you are providing value to your core customer, like real tangible value. That's what I would ask founders to focus on. Other things can be worked out, but really make sure that you're differentiated and you're providing real value. No, I would be very careful about just launching a Me Too brand.
Love that. Thank you so much, Deb. This has been incredibly enlightening and insightful, and just you shared wonderful examples too that we can all sort of hold on to. Truly amazing event. Quick reminder for everybody as we wrap is, if you want more access to all of our events for the 10th house like these, apply to join the 10th house, and that's the 10th house, and 10 is the number 10. femalefoundercollective.com. And if you are looking for one-on-one advice and feedback about raising capital, schedule a call with an investor on findyournorth.co. Thank you all so much for joining, Deb. Cannot thank you enough.
Thank you. I love what you're doing, Allie. I love this whole organization. It's incredible. Incredible.
Thank you. Thank you. And everyone, thanks for joining.
Thanks, everyone.
See you soon.